Most people assume that when you want to buy silver, you just click a button and it shows up at your door. They assume the price on the screen reflects what is actually available. They assume that because exchanges are still trading contracts, the metal itself must still be moving freely through the system. But as of this weekend, those assumptions have become dangerously disconnected from reality. Because something unprecedented is happening right now in the physical silver market, something that has not occurred at this scale in modern history. Dealers are shutting down, wholesalers are going dark, inventory that was available 48 hours ago has evaporated, and the premiums on what little remains have exploded to levels that suggest the system is not functioning normally. This is not about price volatility. This is not about a temporary surge in retail demand. This is about supply. The reason this matters, and the reason we need to break this down now rather than waiting for clarity, is because what is unfolding in the physical market is telling us something the paper market is not yet pricing in. It is telling us that the availability of silver is collapsing faster than the financial system is willing to acknowledge. And in commodity markets, when physical supply disappears, while paper contracts continue trading, that divergence does not last. It resolves violently, suddenly, and in favor of those who own the actual metal. If you have been watching silver through the lens of futures prices or ETF flows, you are missing the most critical part of the story. The real action is happening in the less visible but far more important world of physical supply chains. And right now, those supply chains are breaking. This is not speculation. This is observable, verifiable, and accelerating. The dealers are not just raising premiums, they are refusing to sell. The wholesalers are not just delaying shipments, they are canceling orders. The mints are not just running behind schedule, they are rationing output. To understand why this is happening now, why it is happening so suddenly, and what it means for the weeks ahead, we need to step back from the noise of daily price movements and examine the mechanics of how physical silver actually moves through the global system. Because the breakdown we are witnessing is not random, it is structural. It has been building for months beneath the surface, and the recent price action has simply accelerated a process that was already underway. The question is not whether the physical market is breaking. The question is what happens next when the paper market realizes it. Physical silver does not move like digital assets. It does not teleport from seller to buyer at the speed of a transaction. It moves slowly physically through a complex chain of intermediaries. Miners extract it, refiners process it, wholesalers distribute it, dealers sell it, and at every stage there are costs, risks, and time delays that create friction in the system. This friction is normally invisible because the system has enough inventory buffers to absorb normal fluctuations in demand. But when those buffers disappear, the friction becomes the story. Because once a dealer sells their inventory, they cannot instantly replace it. They have to order from their wholesaler. The wholesaler has to order from the refiner. The refiner has to wait for the miner. And if any link in that chain is strained, the entire system slows down. What we are seeing now is not just one link straining. We are seeing multiple links failing simultaneously. Start with the dealers. Over the past 72 hours, major online bullion retailers have begun pulling products from their websites, not because they do not want to sell, but because they cannot afford to. When a dealer lists silver at a certain price, they are making a promise. They are promising to deliver that metal at that price, even if it takes them weeks to source it. But if the wholesale price is rising faster than they can update their retail price, every sale they make locks in a loss. They sold you silver at $68, but by the time they replace that inventory, the wholesale cost is $72. They just lost $4 per ounce on a transaction they thought was profitable. This is called replacement cost risk, and it is the reason dealers freeze during volatile rallies. They are not trying to manipulate you, they are trying to survive, because if they keep selling at prices they cannot sustain, they go bankrupt before the rally even peaks. The smarter move is to shut down, wait for stability, and reopen when they can accurately price their inventory. But when every dealer makes these decisions simultaneously, the public market disappears, you have buyers with cash and no one willing to sell to them. This dynamic is amplified by the wholesalers. Wholesalers operate on thin margins. They buy large quantities from refiners and sell smaller quantities to dealers. The business model depends on turnover. But in a rising market, holding inventory becomes more valuable than selling it. If they sell 1,000 ounces today at $70 and the price hits $75 tomorrow, they left $5,000 on the table, so they wait. They tell dealers the metal is unavailable, or they quote prices so high that no one bites. They are not being greedy, they are being rational. Why sell today what will be worth more tomorrow? But rationality at the individual level creates irrationality at the system level. When wholesalers hoard, dealers cannot restock. When dealers cannot restock, the public cannot buy. And when the public cannot buy, the price signal breaks. The futures market might show silver trading at $68, but the actual metal is unavailable at that price. The paper price becomes a fiction. It reflects the cost of a contract, not the cost of the commodity. And the gap between those two prices is widening by the day. Even if wholesalers wanted to sell, they're running into constraints further up the chain. Refiners are the critical bottleneck in the silver supply system. They take raw material from miners and turn it into standardized bars and coins that can be traded globally. But refining capacity is fixed. You cannot just flip a switch and double output. Refineries are physical facilities with physical limits, and right now those limits are being tested. Refiners are reporting backlogs that stretch weeks into the future. Orders that would normally be filled in days are now taking a month or more. This is not because they are slow, it is because demand has surged beyond their capacity to process it. And unlike a software company that can spin up more servers, a refinery cannot just add more furnaces overnight. Expansion takes time, capital, and regulatory approval, none of which happens quickly. What makes this worse is that refiners are being pulled in multiple directions. Retail demand is spiking, industrial demand is spiking, and sovereign buyers are competing for the same limited output. When a government or a central bank places an order, that order gets priority. Retail buyers are at the back of the line. So even though demand from individuals is at record levels, the metal they want is being diverted to larger, more strategic buyers who can move faster and pay more. This creates a hidden drain on the visible supply. The silver that would normally flow into coins and small bars is instead being poured into large industrial ingots or sovereign reserves. The public market sees shrinking inventory and assumes demand is just high. But the reality is that supply is being reallocated away from the public entirely. The metal is not gone, it is just going somewhere else. And that somewhere else is not selling it back to you. The final stage of the supply chain, the mints, is where the public actually interfaces with silver. Government mints and private mints produce the coins and rounds that retail buyers purchase. And right now, mints are operating in crisis mode. They are rationing production, they are prioritizing certain products over others, and they are telling dealers that fulfillment times have gone from weeks to months. This is not a temporary surge. Mints have dealt with surges before. This is a structural problem. Mints are not just running at capacity, they are running beyond capacity and still falling behind. The reason is that minting is labor intensive and quality controlled. Every coin has to meet precise specifications. Every round has to be struck correctly. You cannot rush this process without sacrificing quality. And quality is what separates legitimate bullion from scrap metal. So mints are stuck. They can either maintain standards and fall behind on orders, or they can lower standards and risk their reputation. Most are choosing the former. They are producing as fast as they can while maintaining quality. But that means orders are stacking up. Dealers who placed orders in early December are being told they will not receive product until late January, and new orders are being pushed even further out. Some mints have stopped taking new orders entirely. They are simply working through the backlog and refusing to add more to the queue. This creates a cascading effect. If mints cannot deliver, dealers cannot restock. If dealers cannot restock, they shut down sales, and if enough dealers shut down, the physical market effectively closes. You still have a price on the screen because futures contracts are still trading, but the actual metal is unavailable. The price becomes theoretical. It tells you what people are willing to pay for a contract, not what they are willing to pay for the metal. And when that divergence becomes wide enough, something has to give. The futures market operates on the assumption that contracts can be converted into physical metal if needed. That assumption is what keeps paper and physical prices aligned. But that assumption is breaking. Right now, there are more claims on silver than there is silver available to deliver. This is not new. The futures market has always operated with more contracts than metal, but the ratio has widened to a level where the system is becoming unstable. When the futures contract expires, the holder has two choices. They can roll the contract forward into the next month, or they can take delivery of the physical metal. Most holders roll forward. They are speculators, not end users. They do not want the metal, they want the exposure. But a small percentage always stand for delivery. And when that small percentage becomes larger, the exchange faces a problem. Better, they have to source the metal to fulfill those delivery requests. And if the metal is not available, they have to either pay a premium to acquire it or declare force majeure and settle in cash. This is the nightmare scenario for the exchanges. It is the moment when the paper market admits it cannot deliver on its promises. It is the moment when the price discovery mechanism breaks. And we are closer to that moment now than at any point in recent memory. The registered inventory at major exchanges has been declining steadily. The metal that is legally available to settle contracts is disappearing. Some of it is being withdrawn by owners who want physical possession. Some of it is being purchased by industrial users who need the metal for production. And some of it is being diverted to sovereign buyers who are accumulating reserves. What remains is not enough to satisfy the outstanding contracts if a significant percentage demand delivery. The exchanges know this, the banks know this, but the broader market does not yet understand the implications. They see the futures price and assume everything is fine. They do not realize that the price they are seeing is the price of a promise, not the price of the metal. And promises are only as good as the ability to fulfill them. While retail buyers struggle to find coins, industrial buyers are securing supply through entirely different channels. They are not browsing dealer websites, they are calling miners directly, they are negotiating long-term supply agreements, and they are paying premiums that never show up in the public price data. This is the invisible market, the market where real tonnage changes hands. And right now, that market is in a state of panic. Industrial users of silver, companies like Samsung, Tesla, and major solar manufacturers cannot afford to run out of supply. Silver is not optional for them, it is a critical input. If they cannot source silver, production stops. So they are willing to pay whatever it takes to secure their needs, and what they are paying is far above the spot price. Reports suggest that off-market deals are being struck at premiums of $10 to $15 above futures prices. This is not speculation, this is industrial procurement. But when industrial buyers lock up supply directly from miners, that silver never reaches the public market. It never flows through refiners into coins. It never appears in dealer inventory. It disappears from the visible supply chain entirely. The futures market does not capture this. The spot price does not reflect this. And retail buyers are left wondering why they cannot find metal when the price seems reasonable. The answer is that the reasonable price is a fiction. The real price is being set in private negotiations that the public never sees. This bifurcation is the death of the paper pricing mechanism. When the majority of physical supply is being traded outside the public market at prices significantly above the public price, the public price loses its meaning. It becomes a reference rate for speculators, not a transaction price for real metal. And once that happens, the credibility of the entire pricing system is called into question. Markets can tolerate many things, but they cannot tolerate a price that does not reflect reality. Laid on top of retail, industrial, and investment demand is the silent but massive accumulation by sovereign entities. Central banks and governments are buying silver not for speculation, but for strategic reserves. They are not buying coins, they are buying bars, large bars, thousands of ounces at a time, and they are not selling them back. Once silver enters a sovereign reserve, it is effectively removed from the market permanently. This trend has been building for years but has accelerated recently. Central banks that traditionally focused only on gold are now diversifying into silver. The reasons vary by country, but the common thread is strategic. Silver is essential for military technology, renewable energy infrastructure, and electronics manufacturing. Countries that want to secure their industrial future are securing their silver supply, and they are doing it quietly through off-market transactions that avoid drawing attention. The problem for the rest of the market is that sovereign buyers have deeper pockets and longer time horizons than anyone else. They do not care if they overpay by a few dollars per ounce. They care about securing multi-year supply. And when a sovereign buyer enters the market, they distort it. They buy in quantities that would normally take months to accumulate, and they do it in weeks. They vacuum up available supply and create shortages downstream. This is not manipulation, this is strategy, and it is happening across multiple countries simultaneously. China, India, Russia, and several Middle Eastern nations are all increasing their silver reserves. The metal they are buying is metal that would otherwise be available to the commercial market, but once it crosses into sovereign hands, it is gone. It does not get recycled back into the market. It sits in vaults, waiting for a future need that may or may not arrive. And while it sits there, the rest of the world has to make do with less. The most visible symptom of the supply crisis is the explosion in premiums. The premium is the amount above the spot price that buyers pay for physical metal. In normal times, premiums are low and stable, a few dollars over spot for coins, maybe a bit more for specialty products. But right now, premiums have gone vertical. Products that normally carried a $3 premium are now carrying $10 premiums. Some dealers are quoting $15 or even $20 over spot for immediate delivery. This is not price gouging. This is supply and demand. When supply is scarce and demand is high, premiums rise. They rise until demand falls or supply increases, but right now neither is happening. Demand is not falling because buyers believe the price is going much higher, and supply is not increasing because the entire supply chain is constrained. So premiums keep climbing. They reflect the real cost of acquiring metal in a market where metal is genuinely scarce. But what makes this particularly significant is that premiums are a leading indicator. They signal stress in the physical market before the futures market reacts. When premiums spike, it means the physical market is tightening. When they stay elevated, it means the tightness is not temporary. And when they reach levels we are seeing now, it means the system is approaching a breaking point. High premiums are not sustainable indefinitely. Either the spot price rises to meet them, or the market fractures into separate physical and paper prices. We are much closer to that fracture than most people realize. The gap between what you can buy silver for and what the futures market says silver costs is now so wide that arbitrage opportunities exist, but those opportunities are not being exploited because the metal is not available to exploit them. You cannot buy metal at spot and sell it at a premium if you cannot source the metal at spot. The arbitrage is theoretic. It exists on paper, but not in reality. And that is the clearest sign that the pricing mechanism is broken. The breakdown in physical supply creates a series of cascading pressures that eventually force the paper market to reprice. The timeline for this repricing is uncertain, but the direction is not. When the physical market and the paper market diverge, the physical market always wins. Paper is a claim, physical is the thing, and when claims exceed the thing, claims get devalued. The first stage of repricing is premium expansion, which we are already in. Premiums rise until they become so large that the spot price becomes irrelevant. Buyers stop caring what the futures market says because they cannot buy at that price anyway. They pay whatever the dealer asks because the alternative is not getting metal at all. This stage can last weeks or months depending on how quickly supply constraints ease. The second stage is futures convergence. As industrial buyers and investors realize they cannot source metal at spot prices, they start bidding up futures contracts. They are not trying to speculate, they are trying to lock in supply, but their buying pushes futures prices higher, and as futures rise, spot prices follow. This creates a feedback loop where rising prices validate concerns about scarcity, which drives more buying, which pushes prices higher. This stage is where volatility becomes extreme. The third stage is market fragmentation. If the supply crisis persists, the market splits into two distinct markets. There is the paper market where contracts trade at one price, and there is the physical market where metal trades at a significantly higher price. This is the scenario exchanges fear most because it destroys the credibility of their pricing mechanism. If futures prices no longer reflect the cost of acquiring metal, then futures lose their purpose as hedging instrument. This stage is rare, but not unprecedented. It happened in palladium in the early 2000s, it happened in uranium in the mid-2000s, and it could happen in silver now. From the perspective of the dealers, this situation is a nightmare. They are caught between customers demanding metal and wholesalers unable or unwilling to supply it. They face angry buyers who do not understand why the website shows sold out when the futures price is publicly available. They face financial risk if they sell metal they cannot replace. And they face reputational risk if they stay dark too long and lose customer trust. Most dealers are choosing caution. They would rather miss sales than go bankrupt. They would rather endure complaints than take losses. This is rational behavior, but it creates a problem for the market. When dealers go dark, price discovery breaks. The public has no way to gauge the real cost of metal. The futures price becomes the only visible price, even though it is not a price you can actually transact at. And this creates confusion and frustration. Some dealers are trying to thread the needle. They are staying open but with heavily restricted inventory and high premiums. They are trying to price the risk into the transaction so they do not get caught on the wrong side of a volatile move. But even this approach has limits. If the market continues to rise, no premium is high enough to cover the replacement cost risk. At some point, the only safe move is to stop selling entirely and wait for conditions to stabilize. What we are witnessing is the slow shutdown of the retail physical market. Not because demand has disappeared, but because supply has. Dealers are not refusing to sell because they do not want your money. They are refusing to sell because they cannot reliably fulfill the orders. And in a business where reputation is everything, failing to deliver is worse than not selling at all. For investors who have been accumulating silver for years, this moment represents a psychological shift. For a long time, the narrative around silver has been about patience, about waiting for the market to recognize the value, about enduring the manipulation and the suppression and the long periods where nothing seemed to happen. But now something is happening, and it is happening faster than most expected. This shift from patience to urgency is powerful. It changes behavior. People who were content to dollar cost average over time are now trying to accelerate their accumulation. People who were skeptical are now becoming believers. And people who were on the sidelines are now scrambling to get in. This surge in urgency is part of what is overwhelming the supply chain. The demand is not just high, it is concentrated in a short window of time, and the system cannot handle that kind of shock. But with urgency comes risk. When people panic buy, they make mistakes. They pay premiums they should not pay, they buy products they do not need, they overextend financially, and they set themselves up for regret if the price pulls back. This is why, even in the middle of a supply crisis, discipline matters. Owning silver is still about long-term positioning, not short-term speculation. The goal is not to own the most silver. It is to own enough silver at a cost basis you can live with across multiple scenarios. One of the common assumptions when prices rise is that miners will respond by increasing production. More price equals more incentive equals more supply. But mining does not work that way. Mining is a long-cycle business with enormous capital requirements and multi-year development timelines. You cannot just decide to produce more silver and have it flowing 6 months later. The lag between decision and production is measured in years, not quarters. Most of the world's silver production comes as a byproduct of other mining operations. Roughly 70% of silver is produced alongside copper, lead, zinc, and gold. This means silver production is not directly responsive to silver prices. A copper miner does not increase production because silver hit $70. They increase production based on copper economics. The silver is incidental. This structural reality means that even with silver prices doubling, the supply response is muted because the primary metal driving the mining decision has not moved proportionally. For the 30% of production that comes from primary silver mines, the response is theoretically more direct. But even here, constraints exist. Existing mines are already operating at or near capacity. Expanding capacity requires permitting, engineering, and construction. That process takes 2 to 3 years minimum. And that assumes the mine has the ore reserves to justify expansion. Many primary silver mines are mature operations with limited room to grow. They can optimize around the edges, but they cannot double output on command. New mine development is even slower. From discovery to first production, a new silver mine typically takes 7 to 10 years. That includes exploration, feasibility studies, environmental assessments, permitting, financing, construction, and commissioning. By the time a new mine comes online in response to today's prices, the market conditions that justified the investment may have completely changed. This is why mining supply is inherently sticky. It cannot react quickly to demand shocks. What this means for the current supply crisis is that relief from the mining side is not coming soon. Even if every silver miner in the world decided today to maximize production, it would be years before that decision meaningfully impacted supply. In the meantime, the market has to work with the supply that exists, and that supply is being overwhelmed by demand that is growing faster than anyone anticipated. The mining response, when it finally arrives, will be too late to address the shortage unfolding right now. There is also a darker possibility. What if miners do not want to increase production? What if they recognize that scarcity is more profitable than abundance? Mining companies are not charities, they are businesses optimizing for shareholder returns. And in a market where premiums are exploding and buyers are desperate, the incentive structure might actually favor restrained production. Sell less metal at much higher prices rather than flooding the market and collapsing premiums. This is speculative, but it is worth considering. Miners have more control over this market than most people realize. Another assumption that breaks down under scrutiny is the idea that recycling will fill the supply gap. Silver is used in thousands of industrial applications. Much of it is theoretically recoverable. So when prices rise, the logic goes, more recycling should kick in and ease the shortage. But recycling is not a simple on-off switch. It is a complex, fragmented process with significant economic and logistical barriers. First, not all silver use is recoverable. Silver in electronics, medical applications, and certain industrial processes is often used in such small quantities or in such dispersed forms that recovering it is not economically viable. The cost of collection, processing, and refining exceeds the value of the recovered metal. This is sometimes called dissipative use, and it represents a significant portion of annual silver consumption. That silver is effectively lost to the market permanently. Second, even when silver is recoverable, the infrastructure to do so is limited. Recycling facilities are not evenly distributed globally. They are concentrated in certain regions with developed industrial ecosystems, and they have fixed capacity. When scrap silver supply surges, recycling facilities face the same bottleneck issues that refiners face. They can only process so much material at a time. Backlogs develop, and the silver that could theoretically be recovered sits waiting in warehouses or e-waste piles. Third, recycling responds to price with a lag. It takes time for higher prices to filter through to the individuals and businesses holding scrap silver. It takes time for them to gather the material, find the buyer, and complete the transaction. And it takes time for that material to be processed back into usable form. By the time recycled silver starts flowing back into the market in meaningful quantities, the acute phase of the shortage may have already resolved in other ways. Recycling is a trailing indicator, not a leading solution. The reality is that recycling can smooth out supply over long periods, but it cannot address sudden shortages. And what we are experiencing now is a sudden shortage. Demand has spiked faster than any supply source, including recycling, can respond. The market is looking for immediate relief, and recycling cannot provide it. This does not mean recycling is irrelevant. It means the timeline for its impact is longer than the market wants to wait. When a commodity becomes scarce and expensive, industries start looking for alternatives. This is called substitution, and it is one of the mechanisms that can eventually ease a supply crisis. But substitution in silver markets is complicated because silver is often used for its unique properties. It is the most conductive metal, it is highly reflective, it has antibacterial characteristics. In many applications, there is no true substitute that performs as well. In some industrial uses, companies can substitute other materials. Copper can replace silver in certain electrical applications, though with reduced performance. Aluminum can replace silver in some solar panels, though with lower efficiency. But these substitutions come with trade-offs. They reduce product quality or increase manufacturing costs in other ways. Companies do not switch to substitutes eagerly. They switch reluctantly when the cost of silver becomes prohibitive or when silver is simply unavailable. The more critical point is that substitution takes time. Even when a viable alternative exists, implementing it requires redesigning products, retooling manufacturing lines, and requalifying the new design with customers and regulators. For complex products like medical devices or defense systems, this process can take years, and during that time, companies still need silver to maintain current production. So substitution, like mining and recycling, is not a quick fix. It is a long-term adaptation. What this means for the current crisis is that industrial buyers cannot simply switch away from silver to relieve demand pressure. They are locked in by their existing product designs and manufacturing processes. Even if they are working on substitution strategies, they still need silver today. And that need is part of what is driving the panic we are seeing in off-market procurement. Industries are not just buying silver for current production. They are buying silver to ensure they have supply while they figure out how to need less silver in the future. There is also a strategic dimension. Companies that successfully substitute away from silver reduce their exposure to future supply risk, but they also reduce their influence over the silver market. If every major industrial user substituted away from silver, the market would shrink and become less liquid. This could actually increase volatility and make the remaining users even more vulnerable to price swings. So there is a collective action problem. What is rational for each individual company might be destabilizing for the market as a whole. Beneath all the market dynamics sits a geopolitical reality that is increasingly impossible to ignore. Silver is not just an investment or an industrial input. It is a strategic resource. It is essential for defense technology, renewable energy infrastructure, and advanced electronics. Countries that want technological and military independence need secure access to silver, and in a world fragmenting along geopolitical lines, that access is becoming a matter of national security. This is why sovereign accumulation is accelerating. It is not driven by profit motive, it is driven by strategic calculation. A country that controls its own silver supply is less vulnerable to embargoes, trade restrictions, or supply chain disruptions. And in an era where economic warfare is as important as military warfare, that independence is valuable. We are seeing this play out in real time as countries impose export restrictions on critical minerals and metals. Silver is increasingly viewed through this lens. The problem this creates for the market is that geopolitical buyers do not operate like commercial buyers. They do not sell when prices get high. They do not care about maximizing returns. They care about securing multi-decade supply for strategic needs that may not even exist yet. When a government decides to accumulate silver, they remove that metal from the commercial market permanently. It does not cycle back through. It sits in a vault off limits waiting for a future that may or may not require it. This also means that the visible supply, the metal that is available for commercial trade, is shrinking faster than production data suggests. Official statistics show annual production and consumption as relatively balanced. But those statistics do not capture the metal disappearing into sovereign reserves. They do not show the off-market transactions happening between governments and miners, and they do not account for the strategic stockpiling that is happening behind closed doors. As geopolitical tensions increase, this dynamic will intensify. More countries will decide they need silver reserves. More strategic buyers will enter the market, and the pool of metal available to commercial buyers will continue to shrink. This is not a short-term phenomenon that resolves when tensions ease. Once a country builds a strategic stockpile, they maintain it, the metal is effectively removed from the global supply permanently. And that structural reduction in available supply is part of why the current shortage feels different from past shortages. The immediate question is how long this supply freeze lasts. Will dealers reopen in a week, in a month, or is this the beginning of a prolonged shortage that fundamentally changes how silver trades? The answer depends on factors outside anyone's control. It depends on whether miners increase output. It depends on whether industrial demand stabilizes. It depends on whether sovereign buying continues at this pace. And it depends on whether the futures market can maintain credibility in the face of physical scarcity. What we do know is that once a market breaks this severely, it does not just heal overnight. Trust has been damaged, participants have been burned, and the dynamics that caused the break do not disappear just because prices rise. If anything, rising prices can make the problem worse by attracting more demand and further straining supply. The path back to normal is long and uncertain, and there is a real possibility that normal never returns. That silver transitions into a permanently bifurcated market where physical and paper trade at persistent premiums. For those who already own physical silver, this is validation. The asset you accumulated is proving its worth, the premiums you paid are looking smarter, and the patience you exercise is being rewarded. But the validation is not the end of the journey. It is the beginning of a new phase where volatility, attention, and risk all increase. Managing that phase requires the same discipline that got you here. It requires resisting the urge to sell too early or buy too late. It requires staying focused on purchasing power, not nominal prices. For those who do not yet own silver, this is a warning. The window to acquire metal at anything close to spot prices is closing. The premiums you see today may look cheap compared to what comes next, but chasing a market that is running away from you is dangerous. If you cannot find metal at a reasonable price, it may be better to wait for a correction than to overpay in panic. There will be opportunities. Markets do not move in straight lines, but those opportunities will require patience and liquidity. If you exhaust both chasing the current move, you will have nothing left when the better entry appears. The physical silver market is not functioning normally. Dealers are dark, wholesalers are rationing, mints are backlogged, and premiums are at levels that suggest systemic stress. This is not a short-term disruption. This is a structural breakdown that has been building for months and is now reaching a critical point. The paper market has not yet fully absorbed this reality. Futures prices are rising, but not at the pace that physical scarcity would suggest. That divergence cannot persist. What happens when it resolves is the defining question for silver investors in 2025. If the resolution is gradual, we see rising prices, elevated premiums, and a slow normalization as supply chains adjust. If the resolution is sudden, we see a repricing event where futures gap higher to meet physical reality. And if the resolution is chaotic, we see market fragmentation where paper and physical trade in separate universes with separate prices. All three outcomes favor those who own physical metal. The degree of favor varies, but the direction does not. Physical silver is scarce, that scarcity is now undeniable, and scarcity, when met with sustained demand, creates value. The dealers going dark is not a problem for silver investors. It is confirmation that the thesis was correct, the metal matters, the supply is limited, and the market is finally waking up to that reality. The nightmare the paper market is about to face is the dream the physical market has been waiting for. The question was never whether this moment would come. The question was when. And the answer increasingly is now.